Alrighty. So, guys, today we're talking about how to invest tax smart in the new financial year. And look, I think it's a great time to be talking tax. I feel like at this time of year, a lot of people start thinking about the last financial year and how they can, what they can be doing now to pump up their tax return and get more money back. And of course, you shouldn't not be thinking about that. But the reality is that when it gets to once the financial year is finished, it can be a bit limited in terms of what you can do to actually change your tax position. So um, the best time to be planning with your tax is at the start of the financial year so that you can make smart moves throughout the year and then you get a better outcome next tax time as you go through. So I'm pumped to share with you some of the key things to be aware of and the things that you should be thinking about to make the smartest moves so that you get the best outcome moving forward. Huge opportunity when it comes to tax because in Australia we pay a lot of tax and we're fortunate to live in a great country. Look, tax is important at some level, but every dollar of tax you save is an extra dollar that you can save, invest, or use to enjoy your lifestyle a little bit more today. So there's a certain financial potential levers that you can use to get ahead, spend less money, save more, invest differently, take on more risk, more leverage. But paying less tax is a really powerful one of these. So yeah, I'm pumped to get into it with you guys. Just before we get into it, the shout out to our event partner Perla for today. If you've been living under a rock and you're not across what Perla are doing, they're up to some pretty cool stuff. So definitely check out what they're doing as well, guys. For anyone that's the first time in one of our webinars, we do a ton of content in a whole bunch of different areas. So we have a heap of events that are coming up. You can check all of those out on our Eventbrite page. There's also a heap of content on the Pivot Wealth website, and you can check us out on socials or the Mo Money podcast, where we put out a couple of episodes a week, helping you understand the key things that you need to know to make smarter decisions when it comes to your money. And subtle, not subtle plug for my recently released book, Replace Your Salary by Investing. So tax is one of the biggest chapters in that book where we get into that, but essentially gives you a start to finish game plan to save more, invest smarter, and ultimately create financial freedom by investing. And just for the lawyers, guys, please don't rush out and make any life-changing decisions off the back of what we cover. I was never here. This never happened. But seriously, if you're making, particularly around tax decisions, if you're making big ones, you want to make sure that you're dotting your I's and crossing your T's before jumping in. Alrighty. So look, guys, getting into it, I know everyone's situation is unique, but there are some common challenges that hold people back around their tax and investing smart as well. The three biggest ones that I see here is that the rules is like a lot of complex rules, hundreds of pages of tax legislation. And, it can be a little bit overwhelming. Also, particularly around taxes, there's some unknown unknowns that that there's stuff out there that you're probably not across, but aren't sure what they are. And good help is really hard to find around tax. The accounting model has now shifted where we used to rely on our accountants to do all of the tax stuff. We can't do that now because their business models have changed such that they're probably not, for a lot of people, not particularly for non-business owner individuals, not the best people to be helping around tax. And what happens as a result of that is that people end up stuck, and they're stuck, not stuck doing nothing, but often stuck just doing the same stuff that you've been doing in the past. What that really means, though, is that you're missing out on the opportunity to be getting better results and getting more out of what you have today. So what we've found is that there's actually three main areas that you need to get right if you want to be smart with your money and be smart with your tax. Structure, strategy, and solution. So structure is about making it easy to save and manage your money, but making it clear how much money that you've got to work with when it comes to your investing, your tax planning, and your strategies and those sorts of things. People don't think about savings too much when they think about their tax planning, but it is actually a really crucial driver, and I'll unpack a bit more about why that's the case. The next piece, which is your strategy, and that's really understanding the different pathways that can take you from where you are to where you want to be with your money. How you invest. Do you buy shares? Do you buy property? Do you create your super? Do you save in cash? Do you pay down debt? Some sort of combination. But then also, how do you structure those investments to be as tax effective as possible? Really powerful, often overlooked as well. And then the third is the investment solutions and the products that you use to back up your strategy. And here you want to make sure that you got good investments that give you consistent progress over time and avoid the downsides and setbacks and those momentum killing mistakes, but also tax effective investment solutions as well. Now, what happens if any one of those three elements is missing? It ends up dragging down the others. If you don't have a good structure, it's going to be really hard to plan smart. And also, it's like you're working with a leaky bucket. You don't have a good strategy, you're going to be leaving a ton of money on the table. Don't have good investments, well, you blow up your cash, but also you're going to be tax ineffective as well. So you do need to get all three of them right. And as we go through today, I'm going to give you some tips in each of those areas as well. So first bit I wanted to cover was around tax basics. Now, in Australia, we work under a marginal tax rate system. Now, what that means is that as your income increases, the rate of tax that you pay increases as well. It's also called a progressive tax system, because not because it's progressive in its thinking, but because it progresses so that you pay more tax when you earn more money. I'll unpack all of the detail there in a sec. But you only get one tax rate. You get one tax rate that basically all of your income from all sources adds up and is taxed at the same rate. So what that means is your salaried income from your employment, overtime income, commission income, interest income on your bank accounts, dividend income from your share portfolio, rental income from your investment property, basically all of your income from all sources adds together and then is taxed at your marginal tax rate. Tax rates, though, are different for tax entities. And I'm sorry to throw a bunch of jargon at you early on in this piece, but essentially a tax entity is any basically any individual or a company or legal entity that has a tax file number attached to it, essentially. So every individual has a tax file number. They are a tax entity. Every super fund has a tax file number. That is a tax entity. Every company has a tax file number. That is a tax entity, trusts, etc. All of those things. And the tax rates are actually different. The tax rules and the tax treatment are different for these different entities. And that creates a significant opportunity when it comes to your tax planning. For individuals, though, and what I mean by PAYG, it's like pay-as-you-go employees, so non-business owner individuals, that investing is the single biggest area of opportunity to save on tax. For a lot of business owners, it is as well, but for non-business owners, it is by a million miles, essentially. And I'm going to unpack why that is as well. Now, these are the marginal tax rates that we work to in Australia and the tax brackets. Essentially, the first $18,000 to $18,200 that you earn, you don't pay any tax on that income. That works whether you earn $10,000, $15,000, $20,000, $200,000, $2 million a year. You don't pay any tax on the first $18,000 of income that you earn. Then when your income goes above $18,200 and up to $45,000, you pay 19 cents in every dollar of income earned within that bracket. 45 to 120 is 34.5%, 120 to 180, 39%, and 180 plus 47%. All of these numbers include Medicare levy, just for anyone that's wondering why they're a little bit different. So that essentially includes the Medicare levy as well. Now, what you can see when you look at these numbers is that obviously, like the higher, once you get above that 180 level, you're paying pretty much half of every dollar of income that you earn out in tax. And what a lot of people don't think about too much when it comes to investing, and this is why the theme of this webinar, Invest Tax Smart in the New Financial Year, is that ultimately your goal as an investor is to replace your salary with investment income. That's why I called my book that title, because that's what I see as the definition of financial freedom. What that means is that over time, you're going to end up with a significant amount of income that's coming from investments. But while you're building that income, you're probably earning a salary or, employment income from other sources, meaning that you've got your employment income and you've got your investment income, which is probably going to push you up to and beyond the top marginal tax bracket. And that's why investing tax smart is so important. Now, as I said, that you can invest in your personal name and then basically all income is attributed to you personally and taxed at your personal marginal tax rate, but you don't have to. When you invest, you can choose to run your investments through other tax entities which are not you, and that creates different tax outcomes. Now, Investing in your personal name, you can invest in your personal name. If you've got a partner, you can invest in your partner's name. You can invest in joint names as well, and that has different tax outcomes attached to it. You can also, and I'm not saying that you should, but you can also invest through your superannuation fund, and that has a huge advantage in that the maximum rate of tax that you pay is 15%, which is way, way lower than most people's marginal tax rates. Now, with super, obviously your money is trapped until you reach retirement age. So I'm not saying it's the first go-to strategy that you'd follow, but what I'm saying is if you choose to invest through your super fund, you are going to pay less tax. You can also invest through a proprietary limited company. So any single one of you guys could go and open up a company tomorrow, start an investment account, and then your tax is capped at a maximum rate of 30%, which can, for a lot of people, be lower than personal marginal tax rates. Or you can invest through a trust. And that basically the key rule of the trust is that they don't pay tax, that they need to distribute their assessable income to another tax-paying entity who pays tax at their marginal tax rate. I'll get into a bit more of the detail around that as well, but essentially gives you a bit more flexibility in terms of who and how you pay the tax on your investment income. Now, I will just call out with your all income is taxed at your marginal tax rate, but even if that income is negative, and that's where negative gearing comes in, particularly negative gearing around properties, which is the most common form of negative gearing. But basically any negative investment income, it can create tax deductions for you, and that creates a strategic opportunity. Capital gains, so gains when you buy a share or a property or basically any investment for a price and then you sell it in the future for a higher price, the difference is a capital gain. And capital gains are also taxable at your marginal tax rate. But if you've held your investment for longer than 12 months, you get a 50% discount on that capital gain, the assessable capital gain, essentially. So again, there's a strategic opportunity there. Now, I've got this slide here that shows the different amounts of tax that you would pay and the different tax rates for income earned by different people within a family. So I've got a family here with mum and dad and two teenage children, one 18, one under 18, as well as a super and a super fund and a company structure. Now, what I've looked at here is to say if you had $10,000 of investment income, how much you end up with after tax is different depending on who owns the investments. If mum owns the investments, her income's $125,000 and her tax rate's $39,000, so she would pay $3,900 in tax, whereas dad would only pay $2,100 in tax. The minor child not working would pay $4,700. The 18-year-old earning a little bit of income would pay $0 in tax. Superfund $1,500, company $3,000. So you can see from this that the difference between the highest and lowest tax-paying entity is a difference of $4,700 in 1 year in tax. And that's a strategic opportunity that exists when you can invest tax smart. Now, you might say, you might think to yourself, well, $10,000 of investment income, that's probably a long way away for me, but you will get there. That is your goal as an investor. And this example I've got here shows how your investment should build and grow over time based on you saving and investing $1,000 every month into the share market. So I get that $1,000 is not nothing, but something that should be achievable for most people over time. So basically, if you invest $1,000 every single month, after 10 years, and this is based on the long-term return of the Australian share market, you can have about $190,000. Keep that going for 20, 30, 40 years, that, 642,000, 1.7 million, $4.2 million. And when you invest, they have this thing called the 5% rule that basically says you should be able to draw an investment income of about 5% without eating into capital over time. So what that means in human words is that if you've got a $1 million investment portfolio, you should be getting an investment income of about $50,000 every year. So if we extrapolate that out in terms of how much income you'd get based on these different levels of wealth, that you would get from $190,000, you're going to get about 10 grand a year in investment income. $642,000, you're going to get $30,000 a year in investment income. 1.7 million is about 75,000, and 4.2 million about $200,000 a year. Now, going back to our previous slide around tax planning, this is with only $10,000 of investment income. So you see that if you're making 200 G's of investment income, it's going to make a pretty significant difference. And I think I've actually got this on one side to show just the difference if you invest in your personal name versus investing in a company with $100,000 of investment income. The difference in tax is potentially $17,000 every single year. So that's $17,000 more income that you have to reinvest to grow your investments faster, or $17,000 of income that you can just spend on retiring early and sooner than you otherwise would. So there's a huge opportunity there when it comes to being smart with how you structure your investments. And, there's a bunch of really interesting, fun, and sexy strategies that we can talk about and we will talk about as we go through today. But your ownership of investments is probably the biggest thing that you need to get right in terms of the opportunity that will change the amount of tax that you pay now and into the future. Jem's got a question, says, why is the 15-year-old daughter earning $2,000 being taxed at 47%? That's a really good question. And sorry, I should have touched on that. So if you're a minor and you've got investment income only and not employment income, you're subject to different tax rates than someone that's earning an employment income. So unfortunately, the tax rates are a bit high. You don't get the tax-free threshold. And the reason that is the case is because historically there had been particularly wealthy families that allocate a lot of investment income to minor children, and then they end up not paying a whole bunch of tax as a result of doing that. So that's not a silly question at all, Jam. Hope that helps. Emma says, if your investments are currently in your own name through Pearler, shout out Pearler, how would you change these investments to a proprietary limited company? Well, you can. So if you own investments in any entity, except for a super fund where obviously there's access rules that exist, but you can sell your investments and then rebuy them in a different entity, or you can do, depending on what the investments are, that you can sometimes do an off-market or in-specie transfer of your investments into another company. Don't jump the gun on that one just quite yet, though, Emma, because when we get into some of the tax structuring stuff, I'm going to talk about a couple of other things, options that might be even a little bit more favorable than a PTY Ltd company. Got a couple of other questions here. Mel, earn more than my hubby, but all investments are in my name. I'm wondering, should I sell and reinvest as a couple? Sounds like I should be. Yeah, well, look, I've actually got that's a really common situation, and I've actually got a couple of client stories that where I've unpacked some tax strategy stuff a little bit later on, and pretty common one, because for sometimes in couples, not obviously not always, but sometimes you'll get a high income. Like often in a couple, there's one person that's more focused on investing in money and a bit more on the front foot with that. It just sort of comes to them a bit naturally. Sometimes that's a higher earner, sometimes it's a lower earner. If it's a higher earner, and that person is more focused on investments, they might be the one that actually sets up the accounts and then end up doing the investing. But because their tax rate is higher, it can be really end up being quite tax ineffective and mean that you pay a whole bunch of extra tax. So just a common one there, but definitely worth looking at as well. And look, guys, I can see a ton of stuff coming through in the chat, and I'm happy to sort of ad lib as much as I can. But just so I make sure that nothing is missed, if you could please pop your questions into the Q&A, then I can just make sure that it actually gets answered, because I can see there's like comments and stuff coming through along with the questions as well. One from Pranav says, I'm making investments in my name but fall under the 30% tax bracket. My wife falls under 20% bracket. Does it mean if I transfer investments to her name and make future investments in her name, or pay less taxes? Yes, that's exactly what it means. If you've got someone in a higher tax bracket, and if the investments are in their name versus if they're in the person with the lower tax bracket, that means that you're going to pay less tax. Yes. Simone says, yeah, are there differences between Pearler and Net Wealth? Look, yes, is the short answer. Like, they're different platforms. They both do very similar things. They're both great companies, great in doing different stuff. Slightly different investments that they give you access to, slightly different ways that they do that, slightly different in fees. Like Net Wealth has a bunch of different managed funds as well as listed investments, but they also charge an ongoing administration fee as well, which makes it depends on how much money you've got, but that can also quite add up. Both good, both definitely have their place, but yeah, there are definitely some differences there as well. All right, I'm going to take one more question and then I'm going to move on, but keep those questions coming through because I am going to definitely circle back. Trouble planning with investments based on current income is that they may change and may take a lower paid job, semi-retire, partner continue to working. How do you plan for that? That is an awesome question. I'm going to defer my answer to that because it's that's covered in a future slide where I'm going to get right into how you can plan with your money. All righty. So I just want to finish this tax basics section off, and please keep those questions coming through. And it's great stuff there on the line. I want to wrap though by talking about the different tax entities, seeing as we're into that, and some of the considerations around them. So firstly, trusts, and I love trusts. I think that they're great. They're certainly not for everybody, but they are really have a structure that has quite a lot of flexibility built into it. So essentially how a trust works, and what I'm talking about here is a discretionary trust. Some people also call them family trusts, but they don't have to be family trusts. Essentially with a trust, you set up a trust, you can open up an investment account, and then you can buy investments. You can buy share investments, you can have cash investments, high interest savings accounts, you can buy property, you can take out mortgages. And the key rule with the trust is that at the end of the financial year, all of the assessable income needs to be attributed or paid out to another tax-paying entity. That can be individuals, and this is why they're called family trusts, that if you're in a couple, you could distribute income to each other. But you can also distribute from a trust into a company, into an investment company. And this is where, and to Emma's question before, that if you went through the planning process and you decided that a structure like this was for you, you would probably get more flexibility by investing through a trust with a view to distributing future income to an investment company than you would by just going straight into the investment company. I'll unpack a couple of reasons why when I get into the company section in a second. But with a trust, you can distribute to different entities in different years. And this is particularly for couples and for couples that are having children and have different incomes. And to that other question that I saw come through as well around, like, as things are changing over time, with a trust, you have the advantage that you can reassess who is distributed your assessable income each year based on what their incomes are each year. So one, if you're a couple, or even that family that I mentioned where you've got the two kids, mum and dad, and a company sitting there, in 1 year you might go, well, mum and dad are both in a high tax bracket, so maybe, and the kids are both minors and they've got high tax rates, so maybe we distribute to a company. But when the 18-year-old starts earning, you might go, well, I could distribute to the kid. Or if mum's taking some time out of the workforce or dad's taking some time out of the workforce, you can distribute to them, and it means that they pay a lower amount of tax. Downside of a trust is that you have to pay money to set it up, normally $2,000 or $3,000 or thereabouts to set it up through an accountant or through a lawyer. You also need to do a tax return for a trust each year, and that comes with a cost, again, similar sort of amount, couple of $1,000s or thereabouts. And that means that if you're going to use this entity, you need to make sure that the benefit that you're getting out of it is going to more than cover the costs that you're paying for it. Otherwise, what's the point? The other downside of trust, though, is that when it comes to property investing, that trusts do not get a land tax exemption. And that means that you start paying land tax from $1 of land that you own through a trust. As opposed to in your personal name, where you can have $800,000 of land without paying any land tax. On a $1 million property, the land tax is about $10,000 a year, so not a small cost. However, when you can stream capital gains in the future, if you do make a significant gain on an investment property, that can recoup a bunch of the costs there as well. So yeah, definitely not for everyone. I would say that if you've got, six figures plus of investments or a clear pathway to get there in a relatively short amount of time. Or if you've got really strong savings coming through each month, that's where it's worth looking a little bit more closely at trusts. Next one that we've got here is investing bonds or investment bonds. Now, these are like a pretty old school structure, but they've got a bit of a revamp in recent years, and there's some really cracking products out there, cost effective, flexible, good investments. Basically, you can own the same investments that you could own in your personal name pretty much through a bond structure. It's sort of similar to a super fund with an investment bond in that there are some rules that if you meet the rules, then there are different tax rates that apply. And the main rule is that, there are two. One is that income is taxed at a maximum rate of 30%, similar to an investment company. But with an investment bond, if you hold your investments for 10 years or more, that you don't pay any capital gains tax on the gains that you make, which is a massive, massive advantage. With a bond, you're not really locking your money in for that 10-year period, though, because you can start a bond today, and if you need to sell it in a month's time or 6 months' time, you can absolutely do that. You wouldn't do it that way on purpose. Like if you knew that you were going to sell in 6 months, you probably wouldn't go down that path, but you can access the money. The other rule with bonds is that they have this 125% rule, which basically means that if you can only put in each year, you can only put in 125% of the amount that you put in the previous year. So that means if you put in $100 into an investment bond this year, next year, the maximum amount that you could put in and still access the capital gains tax concessions is $125. And the following year, it would be $150 and change, and so on and so forth. And what that means is that if you start an investment bond and you don't contribute in a year, that you can't essentially put any more money in and continue to access those tax concessions. But as I said, that they used to be really popular back in the day, but the products were quite expensive. You really needed to have a financial advisor. The investment selection was a little bit lacking. These days, that has changed, and there's something that is really worth looking into. We're using these quite a lot with our clients at the moment as well. Has a pretty significant advantage. Super funds, a little bit on the boring side, I suppose, compared to some of those more sexier things. But super is the most tax effective place that you can invest. 15% maximum tax on income, capital gains tax at 15%, maybe 10% if you've held the investments for longer than 12 months. With super, you can invest in the same stuff that you can invest in outside of super, so long as you choose the right super fund. But there are restrictions on accessing the money. So you need to, only put money into your super that you don't need until you're older. But it's important to be careful with your planning there. Now, a couple of questions here. I'm 25 years old, about to get a check for 40K. What should I do? That's a great question. That's actually the most common question. Well, maybe not in that exact specifics, but most common question that I get asked as an advisor. The answer is that it depends. It depends on, what do you want in the short term? How are things going to play out over the medium term? What's the important things for the long term? With that one, I might just park it until I get into the planning piece where I can unpack how you would tackle that in a little bit more detail. Paz says, how do you calculate investment income precisely? Let's say I have 5 ETFs and 2 bonds. I would say a spreadsheet is your friend there. Get the income return on each of those investments and then whack it into a spreadsheet would be the way that you would go about that, Paz. Hope that helps. Our rule says there are cons of investing on company or trust name as well for capital gains tax concession is not applicable. That's a really good point. Yes, and I should have actually mentioned that in the company. I think I actually had it on the slide, but I might have forgot to mention it. When you invest through a company structure, you do not get the 50% long-term CGT discount. So you generally, you don't really want to be having investments that have big capital gain potential in an investment company. That's important if you go down that path, that you want to be strategic with which investments you put in which entities, for sure. That's a really good point. what I've seen some people do is that if you want to have, like US shares are generally higher growth, lower income, Aussie shares are generally higher income, lower growth. So you can be considered with what you put where, and that can mean that it has less of an impact, but it definitely still does have an impact. So yeah, that's a good point. And look, I should have mentioned as I was going through, guys, if you're thinking about setting up entities for your investments, please, please, please get some good advice. This is our sweet spot, so you can talk to us or talk to someone else, but talk to someone because it's not something that you should do lightly. It will have a significant impact both this tax year and in the tax years to come. So please, it's worth paying a few bucks and getting your I's dotted and your T's crossed before you jump in with that. Thank you for raising that, Rule. Lisa, tax accountant. Great prezzo so far. Slightly off topic, but how do I find a good accountant? Yeah, that's a good question. I wish I knew the answer to that one. It's getting increasingly difficult, but it depends on what sort of accountant you want, what position that you're in, because different accountants will specialize in different areas. Unfortunately, though, there's not a ton of great accountants that do great work for individuals, because most accountants want to work with business owners where they can charge more and get paid for their work properly. If an accountant's only charging a few $100 for a tax return, which seems expensive to a lot of people, they really have to minimize the amount of time that they actually spend with you. And that's why, particularly if you're thinking about holistic sort of tax planning stuff, it's probably more the job, and particularly thinking forward, probably more the job of a financial advisor than it is for an accountant. I appreciate that that's probably not a lot of help, Lisa, but hopefully that sparked a couple of ideas. Bruno, reinvestment bond, CGT exemption applies for non-tax residents too. I'm not sure the answer to that one, Bruno. That's probably something though that you could Google up pretty quickly, I would guess. But yeah, I do not know. We don't do tons of non-resident stuff, so not too sure. Another question from Lisa: is investing via a super fund the same as increasing your super contribution? Yes, essentially it is. Essentially, it's putting money into your super and investing through super. Or even if you don't increase your super contributions, you do still have investments in your super fund. So yeah, that's sort of part of it as well. With the investment bonds, is the concession from when it started or when you put the money in? That's a good question. I think it's from when you put the money in. Yeah, I think the initial contribution commences the 10-year rule is how it works. All right, I'm going to take one more, and I'll take this one because it's giving me a compliment. This is a fantastic session. Thanks for presenting. It can be confusing in a really precise way. Question about pivot wealth. I'm new to investing, don't have a whole lot of cash and assets, but I'd like to increase this over time. Picking up some of your points, structure and entities sounds like it could be a good idea to ensure everything is set up correctly. Is this something we help with? Yes, that's exactly what we do. That's how we help people. And I should have mentioned at the start, I'm being a little bit forgetful today, but I've got a special bonus just for you guys on the line today. So stick around to the end, and I'll talk about next steps and how you can get a little bit more support around this stuff moving forward as well. All right, I can see those questions. Keep them coming through. I'm going to get into them, but there's also a bunch of slides to cover, so I'm going to crack on a little bit. I want to change gears a little bit and talk about the different types of investments and some of the tax considerations around them. So 4 main types that we've got here: saving money in cash, paying down debt, buying property, buying crypto, and shares are in there as well. Cash savings. Now, income is taxed here at your marginal tax rate. And that's something a lot of people don't think about. You need to keep in mind when you're saving money in cash, even in a high interest savings account, that the real return to you is the return that you get after inflation. So at the moment, high interest savings accounts are paying about 5% or so, but inflation is 6%. So your real return on cash is going backwards. They're great from a risk management perspective, though, because when you save money in cash, then it's essentially government guaranteed up to a level, so not going to go backwards. Last point here, you're not going to get rich saving money in cash. Also, tax ineffective in that it's all just income and it's all just tax to you. Paying down debt. And I think it's important to split this one out here between deductible debt and non-deductible debt, because when debt is tax deductible, the after-tax interest rate is different, and the after-tax interest rate is the only interest rate that's really important. I get a lot of questions from people, particularly like when they're talking about being tax smart, but also in the current environment. Do you pay down debt or do you invest? Or what is the right split of those? There's a simple answer and there's a longer answer. But the short answer here is that you want to compare the expected return on your paying down your debt versus your investments. Excuse me. This is why it's important that you understand what your after tax interest rate is, because if you've got non-tax deductible debt, if your headline interest rate 6%, your after tax interest rate is 6%. If you've got tax deductible debt and your interest rate is 6%, then your after tax interest rate is probably 3 to 4%. So you want to compare, if you're thinking about buying shares, long-term return on shares about 9%. So you're looking at 6% versus 9% or 4% versus 9%. You can see that the long-term return on shares is expected to be slightly higher than on debt, but when you pay down debt, your return is guaranteed. And there's very few guarantees when it comes to investments. Certainly there's none in the share market. So that's a consideration as well. Paying down debt also has the impact of boosting your cash flow and meaning that you've got more money that you can invest and invest in a way that's tax smart as well. So that's not a small thing. Shares, managed funds, ETFs, micro investing, I put them all in the same bucket. They're about split depending on the shares that you buy, but half income, half growth. With shares, though, you can get franked dividends on the shares. And franked dividends basically means that you basically, when you own shares in a company, you own a tiny little percentage of that company, and you're entitled to a small percentage of the profit that's generated by that company. Now, in Australia, for Australian companies, when a company they generate revenue and they make profit, then they pay tax on the profit, then they pay out their dividends from their after-tax profit. What that means is that when you receive the dividend, because it's paid from after-tax profit, you get a tax credit for the tax that's already been paid on the profit before it comes to you as a dividend. That gives you a significant tax benefit over time. And basically, I looked at the stats around, and I probably should have put it in a slide, but if you were to replace the average income in Australia, average income is $92,000. To do it with non-franked dividends, you'd need to have $1.8 million in investments. To do it with a franked dividend, an Australian share portfolio that pays franked dividends, you'd only need about $1.3 million. So you basically need $500,000 less to get the same after-tax income. Pretty powerful stuff. Property has a gearing benefit that's attached to it. Gearing just means borrowing to invest. So when you borrow to invest, that's called gearing, or it's called leverage. Now, when you've got a property as an investment, basically the net income of that property is tax deductible. So if you've got an investment property, you're going to get income in the form of rent, and then you're going to have expenses in terms of your mortgage interest costs, strata, all of those ongoing property costs. You add them all up together, and if the number is negative, then you've got a negatively geared property on your hands, but that negative number subtracts from your taxable income or gives you a tax deduction and is refundable at your marginal tax rate. So that can significantly reduce the after-tax costs that you pay for your property and mean that you've got a nice investment property that's growing for you and giving you some tax deductions at the same time. Now, whether you own property as your own home or as an investment property, there is the ability to make your debt tax deductible through using debt recycling strategy. And I'm going to unpack that strategy in a little bit more detail as well. Crypto, I put this one in just for completeness. I'm not saying rush out and invest in crypto, although I do think it's an interesting space to be in. But when it comes to crypto, there essentially is no income. Except for staking, which thankfully has significantly reduced in terms of its popularity after the UST Terra Luna implosion last year. But there's essentially, it's a very tax ineffective investment. Be aware with cryptocurrency that basically anytime you buy and sell crypto, that is a transaction that needs to be reported to the ATO. And if there is a gain or a loss, then that needs to be reported. Particularly if there's a gain, tax needs to be paid on the gain. And a lot of people don't think that. A lot of people think that if they put $5,000 into a crypto trading platform and then they trade in and out, it's only if they take the money out that they need to start reporting stuff. That is not the case. You need to be reporting all of those transactions, and you can get caught with some unexpected tax consequences as a result. So be careful there. Now, getting into tax strategies and the strategies that you should be aware of. The first one is franking credits, which I touched on. Really powerful strategy, and in one that a lot of people don't think has as much impact as it actually does, but it's really powerful. So be aware of it. Think about it, particularly when you're thinking about who's owning what investments. And if you've got investments in your personal name, investments through other structures, you want to make sure that you got the right investments in the right places to get the best tax outcomes. Negative gearing, debt recycling. So essentially how debt recycling works is it's a strategy that can help homeowners pay off their mortgage, create some tax efficiencies, and build a share portfolio and share investment income at the same time. Essentially, how it works is that if you own your own home, that debt on that home is not tax deductible because the purpose of your borrowing is to own your own home, not for the purposes of investing. With a debt recycling strategy, how it works is you essentially pay down that non-tax deductible debt. So say you've got, and I'll just use round numbers here, say you've got a mortgage of $100,000 and you've got $10,000 sitting in your bank account. You can pay the $10,000 into the non-tax deductible home loan mortgage and then take the $10,000 out and invest that money into a share portfolio. If you do that, then the purpose of you taking that $10,000 out is to invest, and therefore the interest that you pay on that debt is tax deductible. Now, I should call out that in practicalities of doing this, there is a little bit more complexity than my simple explanation suggests. So I'm not saying that this is an end-to-end game plan in doing it, but essentially it works. You put money into the non-deductible debt, you take it out, you invest it. That makes that portion of the debt deductible. Over time, what you can do is essentially convert your entire mortgage into a nice tax-deductible mortgage, significantly reducing your after-tax interest rate, building a share portfolio. And if your debt is, even if your mortgage costs are 6%, which they're not after you make it deductible, and the share portfolio is growing at 9% over the long term, your share portfolio will grow faster than what your debt is at. And at any point, you should be able to pay down your sell down your share portfolio, pay off your mortgage, and have profit left over. Need to be careful with the share market, obviously, but it's a really good strategy that can help in a whole bunch of ways. And one of the best parts from a risk management perspective with this strategy is that your debt levels never actually increase, because if you pay the $10,000 in and then take $10,000 out, your debt levels have not increased at all. Borrowing to invest is always risky, but when you do it in this way, it means that you're not amping up your risk in that the debt levels are essentially the same. Super contributions is another really, really effective tax strategy. So every person in Australia can make tax-deductible super contributions of up to $27,500 each year and claim a tax deduction, including the money that's contributed on their behalf by their employer. Now, current super contributions is 11% of your salary, but for most people, that leaves a pretty significant amount of money that they could put into their super and claim an upfront tax deduction for. Once the money gets into super, all future investment earnings are taxed at a maximum rate of 15%. So not only do you get a tax deduction on the way in, but once the money's in there, it's going to grow faster because you're paying less tax inside your super. Now, I get with the restrictions on access that it's not going to be the first strategy that you throw all your money into because you want to have investments outside of super. But because of those tax, the tax benefits are compelling such that, while it's probably not going to be the first strategy, it shouldn't be your last either. Couple of practical ones here. ATO timeline. So if you've got a tax bill in particular, and so long as you use a tax agent, you don't actually need to submit your tax return and pay until May of the year after. So for the financial year that's finished, you don't have to pay your tax bill until May of 2024, which means that if, the money can be sitting in your bank account, your offset account, your high interest savings account for a lot longer. And God knows the ATO sit on so much Aussie of our cash that while they're waiting to give us our refunds, for me, I think it makes sense to take advantage of those timelines. Deductions and records. This is a little bit off script from the, invest tax smart piece, but most people miss out on claiming tax deductions because they don't keep good records. But reality is that, you want to know what you can claim and what you can't, and keep your good records throughout the year to make sure that you get the most back when you do your tax return. Private health insurance is another thing that you pay. If you earn more than $90,000 as an individual and $180,000 as a couple, you will pay extra tax if you don't have private health insurance in place. So know what that's like, an extra surcharge that they charge. So, be aware of that, and, take advantage so that you're not paying more tax than you need to. For particularly if you're young, the cost of health insurance can be less than the cost of extra tax. Tax and investment advice, and also just general education, is a big deduction area that a lot of people overlook. So basically, fees for tax planning advice and fees for building your investment income over time, advice fees, are tax deductible under the ATO definition. So look at leveraging them. It can help you save tax and get ahead faster. And yeah, sort of, you mean that you're only paying after tax. Planning in July and April is effective here, as I sort of touched on at the start. Now, a few questions that I got coming through here. So I'm currently at the maximum tax rate, and my super contributions via employees are over the limit, so I get money returned every year. Can I still add additional money into super? Yes, you can. You can only do it through after-tax contributions, though. So there are two contributions limits for your super fund. One is what's called a concessional contribution limit, and the limit for that is $27,000 each year. For a non-concessional or after-tax contribution, the limit's just over $100,000 a year that you can put in of after-tax dollars. You don't get a tax deduction for putting that money in, but also once you get it in, the money is invested into the lower tax superannuation environment, which has its own advantage. So yes, that you can, and that's how you do it essentially. That's the same question. If we change our current investment structure, does it trigger a capital gain? Yes, it does. So if you switch in investments from your personal name to a trust, to an investment bond, or whatever else, it will be a capital gains tax event. And that's why it's important that you plan smart at the start so that you don't have to unwind things later on. Alex says, do these methods change if you're looking at estate planning as well? Yes, it can do. It can do. It depends on what your estate planning is its own beast. There's no drastic estate planning disadvantages for a lot of those structures that I mentioned, though. So hope that helps. Does Pivot Wealth set up structures and invest on behalf of? We don't physically set up like trusts and companies for our clients, but we work with their accountants to do that. And then we do set up accounts to invest for our clients. And that's, I think you want specialists in those different areas when you're getting that more complex type advice. Oliver, with the student loan indexation at 7.1%, if you can afford to pay it off, would you suggest doing that? What would you suggest to consider? I think with HEX indexation, and this is a little bit, sort of tax, sort of not, but with HEX indexation it being so high, I think you should probably be looking at it. I just paid off my HEX last year before the threshold. I had it sort of sitting there that had been for my master's degree for a little while. While it was 1.5%, didn't bother me. At 7.1%, it did. So I paid it out. That also helps with your cash flow and stuff as well. So I think if you got the cash there, it's definitely worth looking at. Guaranteed return, good for cash flow as well. All right, keep those questions coming, guys. I'm going to crack on, though, just a little bit mindful of time. Myths and mistakes. So knock tax planning before you invest is a really big one. And look, if you're just getting started, it's probably fine. But as things start to get more serious with your investing, you really want to be considered around your tax and looking at, how your investments are likely to build over the short and medium and longer term. And then what does it mean from a tax perspective so that you can be strategic on your tax structuring? Investing for tax purposes alone is a huge mistake, and it's something that I've seen a lot of people run into a bunch of trouble with, that you never want to invest for tax purposes alone. If an investment isn't good without the tax benefits, it was never a good investment to begin with. Staying in a lower tax bracket is a big myth as well, that some people think when their income is going up that they need to actually find a way to stay in a lower tax bracket. There's no point in which you earn a higher income and do not and end up with less money after tax. So you don't, while it is always good to, as you're going into those higher brackets, to find ways to get more deductions, you never end up with less money. So it's all probably fine. Set and forget is another one. The tax rules are changing all the time. Your situation is changing all the time. So it means that unfortunately you need to stay on the front foot with your planning here. And advice with an agenda is another thing that sometimes I've found that people will get advice, particularly from accountants, that can be really gung-ho on setting up tax entities. And as you can probably tell from the stuff that I've covered already, like, we love these tax entities, but you do really need to make sure that you're getting a benefit beyond what you're paying for setting them up and the ongoing management. So it's not just your accountant that's benefiting here. All right, so I'm going to get into client stories. I'm just going to give you the super quick version of these, though, because I don't want to skip over them, but I am just a little bit mindful of time here. Now, this was a couple, late 20s. They were on a $220,000 income, had a bunch of savings sitting in the bank, never invested. They were saving $4,000 a month. They wanted to buy a dream home, $1.2 million. But to get there, they felt like they needed to have $300,000 in savings. That wasn't for the mortgage, but that was to have enough for them to feel comfortable that they could buy that place. They realized that it was 3 years away. Now, what we ended up doing was we realized that they were going to get a ton more benefit. While they really wanted this $1.2 million home, they were going to get a ton of benefit from buying an investment property at a slightly lower price point and making it happen sooner. We managed to make it sooner by ramping up their first home super saver scheme contribution. So that's basically you put money into your super, claim a tax deduction, then you can take it out to buy your first home. They put in $90,000 that they got tax benefits for. And that created over $10,000 in tax savings, which is $10,000 more that they had for their property deposit. They bought the property, lived in it for 6 months so they could access all the first home saver scheme benefits, but flipped it to an investment property to create further tax deductions. And the view was to use it as a stepping stone towards getting that $1.2 million home and having it happen sooner. Another couple, pretty relatively high income, $350,000 home they had an ETF portfolio, 175K, so a share portfolio, and they were saving pretty well each month, pumped with tax bills. What we ended up doing, they bought an investment property, but the big one was around their debt recycling strategy, that we basically sold down their shares, paid down the mortgage, redrew, and then purchased some different investments in their investment portfolio. Overall, it created $12,000 of tax savings in the first year. That plus the property benefits meant $50,000 upside within a 12-month period. That's the power of being smart and strategic around investing. Now, this one was very aligned with the scenario that Emma had the question on at the start, where you've got a couple where one is in the top marginal tax rate and one isn't, had all of the investments, though, owned in the higher earner's name. They wanted to buy their own home, but all of the investments were set up in the wrong way from a tax perspective. When we flick things over, basically created a $6,000 tax saving in year one, but with so much more potential for tax saving into the future. Now, for these guys, they invested an extra $60,000 in 12 months, and we looked at how that would grow. $937,000, pretty good money, but when we got into it, they'd actually been sitting on the fence for doing this. They knew they needed to do something for 2 years and realized that the opportunity cost of them not taking action was actually $200,000. So the money, like, they ended up on a good path and they're going to be fine, but they were kicking themselves because they'd sat on this for so long. And this is why it's so important with this stuff. Take action. It's not just going to happen on its own. You need to make it happen. All right, so I'm just going to skip over a couple of these slides and give you the quick two on how to plan with your money. Now, this is the process that we use at Pivot, but it's the same process that anyone needs to use if they want to plan, want to create a considered plan around tax and investments. First thing, focus in on what's actually important to you. What does a great result look like? What's important to you? Where do you not want to be? Now, from there, you can start to go, okay, well, what are the moving parts that are going to impact my plan? What money's coming in? What money's going out? Where's it going? And then you start to look at, okay, well, what if we did these different things? What's the financial impact? What's the risk? What are the trade offs? Put it together into an action plan, automate, and then you can just follow the bouncing ball. When you do this, you put yourself in a position to take confident action. You obviously make smarter decisions around your tax, find a good balance between getting ahead and living a good lifestyle at the same time, and maximize the right opportunities. This model talks about getting from where you are to future state with your money. When most people think about getting from where they are to future state, they think about it like a straight line. But because of the compounding impact of time and money, it's actually a curve. Now, if you're not 100% on track to end up exactly where you want to be with your money, that means that you need to do some stuff and jump the line. Once you do that, you need to, start that investment account, sort out your tax planning, et cetera, et cetera. Once you do that, then it's just about taking the next step and the next step, which is easier because you're on the path. But the longer you leave it, the more time goes on. The jumping the line piece becomes, you have to do more to end up in the same spot. So the jumping the line can become more painful, and putting yourself in the best position can become impossible. So the sooner you start, the easier it is. It doesn't matter what money success is to you. That if it's, for most people, it's that you've got a house, paid it off, and you've got X dollars a month of passive income. To achieve that, you need to save a certain amount of money today. If you wait a week, a month, a year, 5 years, you just need to save more and invest more to end up in the same position. So, look, guys, I can see there's a ton of questions, and I'm going to come to them in a sec. But I've got something to share with you in terms of next steps and how you can move this forward. Now, one of the things that we do at Pivot Wealth is this Smart Money Accelerator, which is essentially a service that helps people save more and invest smarter to accelerate how quickly you get ahead. Now, what you should know, we're not. It's not like we're special and we've got some super secret black magic or anything like that. We've just got a system that works, and anyone can do this. Now, this service is set up basically a training, education, group, and one-on-one coaching to help you get ahead without making drastic lifestyle sacrifices. It comes about from the decade plus that we've put into working with some of the biggest organizations in the country in terms of creating financial support for their teams, but we wanted to make it accessible to people that didn't have a company that wanted to spend 6 figures a year on their financial well-being. Also, we know that financial advice, and we do this, what I, in my totally biased opinion, think is pretty awesome financial advice, but it comes with a significant price point. Starts at like $800 a month. We wanted to make it accessible to more people to help you get there sooner. So we've taken all the lessons that we've used from helping people build $750 million in wealth and essentially made it available to you, where you create this clear plan backed up by online education, so you know every single step, and you learn all of the tools, investing tools and tax tools and money tools to level up your game. It's all backed up with all checklists, guides, cheat sheets, basically giving you step by step exactly what you need to do to make things happen. And as a bonus, at the moment we're offering this with private one-on-one coaching to accelerate your results even further. I'm so confident in the results that this thing delivers, and we're already seeing a bunch of these come through. But essentially, it's got a money-back guarantee that if you follow the process and you're not happy with the results, we'll gladly give you a full refund. That's how much we back it. So basically, yeah, the detail, how it works is that we do this quarterly 90-day game plan, which is really the core part of your money plan. You set your targets, you know what you're doing short term. Then it's backed up by all of this education and the ability to ask any questions and get them answered by a financial advisor. Monthly events, like we're doing one on Friday, what's going on in the investment and property market. We've also got Q&A sessions and a bunch of other stuff, and backed up with this online learning where we give you these financial foundations, content, saving, investing, property, super, basically exactly what you need to do to nail it with your money. A couple of bonuses. First time we've made our app available to the public. Basically set your goals, track your progress, and get insights on money opportunities and issues. Private one-on-one coaching with a licensed advisor helping you accelerate your results. That's worth a couple of $1,000s a year, which we're including as a bonus, as well as investing this online training around how to invest smarter when the market is crashing. Now, total value of all that stuff, a bit over $8,000, but we're offering it at the moment for $330 a month. It's a month-to-month agreement that you can opt out at any time. And just for you guys that are online today, we've set up a discount of $100 on your first month, which you can use by using the code GetTaxSmart at checkout. I've got the link for it here. That code expires at midnight tonight. So it's just for you guys online today. $100 off your first month, so you can try it again. The money back guarantee is there. All right, guys. So, bit mindful of time. I'm going to stick around for another 5 minutes and answer a few questions. I appreciate some of you guys need to go, but if you do have 5 and you want to hear a few questions, I can see that there's actually a ton that's come through here as well. Appreciate all the comments coming through, guys. You are very welcome. Alrighty, so Pass has got a question. Investment income, do you consider the sum of dividends interest during the year or also something else? No, it's just the dividends that you receive and the interest income that you receive on your money is the investment income that's attached to it. Hope that helps. I have a property overseas, mortgage has 5 years to run and rental income won't cover it all to zero. Should I invest rental income rather than trying to pay off the mortgage and capital each month and use my own money to do that? If investing this income, how do I do that when I live here? Mel, that's a really hard one for me to answer without getting right into all of the ins and outs of your situation. But it sounds like either of those, and I suppose the question illustrates that any of those things can be good. Like ultimately having a clear path to pay off your mortgage makes sense. Investing also makes sense, but you've got to make the right move at the right time. So I think striking the balance there is important. I would suggest you probably want to wrap that together into a plan where you can see how everything is playing out short, medium, long term. And that's going to probably make the answer clearer as well. Sorry, not a lot more helpful there. Cameron says, if I invest through super with the plan to withdraw the funds later via first home saver scheme or tax salary sacrifice, does this mean that the tax is only paid on the portion of the money that has increased while in super? I'm just making sure I'm following this one via to save money on tax by salary sacrificing. Only tax paid is on the money that's increased with super. Look, with the first home super saver scheme, you put money in, you get a tax deduction. When you take the money out, you pay a bit of tax, but it comes with a tax offset. So that basically the benefit to you in total should be 15% through the first home super saver scheme. With general super money, that's a little bit different. It depends on how you structure super pensions and all of that sort of stuff. Hope that helps. It is a little bit complex in terms of those rules. So I'd suggest if you're thinking about that, maybe get some structured advice there as well. Thanks for the session. Are there any good resources you would recommend for learning more about debt recycling? Well, in my biased opinion, I'd probably suggest the Smart Money Accelerator, which I was just talking about. But yeah, you could check out our socials for stuff, but I don't know of a definitive resource on that, although I am thinking about putting something together. So maybe if I get enough demand, I will. How complex is debt recycling? Do we have good products to do this, or do we invest directly in shares or ETFs? You just do it. You just invest into shares or ETFs to do it. It's not like they don't have debt recycling products where it's like a mortgage and an investment account built into one. It's just like using the tax rules to your advantage there. Chris says, with increased interest rates, how would you work out whether paying down a principal of place of residence loan is a better strategy versus continuing to put surplus money into a share portfolio instead? Yeah, it's a good question. And I sort of touched on it in that earlier comments around debt, Chris, that particularly with your PPOR debt, you can look at, okay, what's the mortgage interest rate, which is probably 6-ish% at the moment. What's a long-term return on shares, which is 9%. So the difference, and 9% is then taxable. So your after-tax interest rate, your after-tax return on the shares is probably 7%, maybe a little bit lower even, but it's still 1% more than what it would be on paying down your home loan debt. But if you've just bought a property and you say you've got a $1 million mortgage and your cash flow is a little bit tight, there's probably an additional advantage for you in paying down that debt because it's going to help with your cash flow. It's going to reduce your risk management. Whereas if you bought your property 10 years ago and you got a 50 grand mortgage, you might go, well, my cash flow is good. My debt levels are really low. So I'd probably, if that was me, I'd probably be more inclined to invest in a share portfolio than I would to pay down the debt. So where that tipping point is, it really depends on the individual, but you can look at the numbers, but it's also then you look at the risk management, and the best strategy is the combination of those two. I hope that helps, Chris. Some ETFs provide trust income, dividend income, and franking income. Do these need to be claimed outside of the CGT? I'm not super familiar with that, or perhaps I'm maybe just not reading that correctly. But basically, if you've got ETFs that you want to report the dividend income that you receive as well as any gains that happen, depending on what platform you own them on, your ETFs on, then sometimes they will give you a statement that outlines all of that stuff in a bunch of detail. But yes, you need to report all income as well as any capital gains as well. Generally, June 2023 dividends are paid in July 2023. Does that income reported in 2023 or 24? 24 is the answer. So the dividend income you receive in this financial year is credited towards this financial year, even though if it was earned or generated in the previous financial year by the company, if it wasn't paid to you, then it's accessible in the year that it's paid. Another question for Bruno, are franking credits paid to super? Yes, they're refunded as cash to super funds. That's why there's so many retirees that have big share portfolios in their super funds. Another super question from Brad. If I switch investments within super, does it incur CGT? Yes, is the answer to that. Basically, anytime you're selling investments, inside super, it's a capital gains event. So whether it's only got capital gains tax if there's a gain that's paid, but yes, it is a CGT event. Question says, who makes the decision on what to invest in, shares to buy, sell, etc.? Is it Pivot or the client? What role does Pivot play? Well, look, ultimately, the question is with a financial advisor, who makes the call? And there are different advice companies that do it differently, but for us, our clients make the decision. Our job is to give them recommendations, and then they can choose to accept the recommendations or not. Our clients, we only really recommend things when we know that that's what our clients want. So our clients do accept our recommendations, but our role is to advise and make recommendations. So I hope that helps. Angela, very helpful. You're welcome, Angela. I earn more than my husband and close to my top of my current tax bracket. If I'm predominantly investing in Australian companies that pay dividends that are paying frank dividends, am I best to keep investing in my name to get the credits? Well, if you're one, I can't answer the question is what is best, but what I can say is that if you're getting franking credits, the franking credits are going to be more valuable to someone in a lower tax bracket than someone in a higher tax bracket. The reason being is because essentially it means that you getting, depending on if their income is right at the tax-free threshold, then no. But assuming that they're paying a reasonable amount of tax, that you want the income in the lower person's bracket will mean that they get less, they pay less tax overall. While your tax rate is higher, having the income in your name will mean that you pay more tax on it. So you're generally going to be worse off overall. Hope that makes sense, Angela. Mel says, a couple of questions from Mel actually. Plan to move overseas and have investments in 3 countries. Is tax planning more important? I would say yes. It means that it's going to be complex though, but yeah, I'd say that you want to make sure that you're leveraging the different bits to your advantage for sure. Mel also asked, how long do people generally stay in your program? Well, it depends on the person. The Smart Money Accelerator, we only launched this year. So most people that started with us are still in the program. With our advice, it depends on what's going on in their situation, but usually it's at least a year. I'd say that on average is probably 3 to 4 years. All right, I'm going to take one more question and then I'm going to leave it there. I really appreciate all the questions coming through, and nice work to everyone on staying on to learn as well. It's a ton of great questions today. So, yeah, great to see that stuff coming through. So, when owning a property 50-50 with someone, the banks seem to still make you liable for the whole property, even though you're exposed to 50% of the income growth. Is this something you've seen a lot? Do you suggest staying away from part ownership due to reducing your borrowing capacity? Great question, Bryce. And yeah, that's something a lot of people don't think about. But yes, it's a definite thing that you need to be aware of. And it can be a real downside to buying a property with someone else. Basically, even though you don't owe the actual money, the banks look at it like you do, which sort of makes sense from their perspective. But yeah, it's a massive downside for you. So I would probably prefer to be maximizing my own borrowing capacity, owning properties that are my properties, as opposed to getting into that. Sometimes it can be helpful if it's really helping you get in the market sooner, but most of the time it's not. So yeah, I hope that helps, guys. Once again, thanks for all the questions. Great to see you online. Check out our upcoming events. There's a bunch of stuff coming through. Appreciate all the thank yous coming through as well. You guys are very welcome. Guys, I'll catch you on the next one. Bye for now.